Question of the week. Is it correct when the person owning the policy dies, only the death benefit is paid to the beneficiary? What about the cash value? What happens to the cash value? This question comes from George, and to demonstrate this, answer this question with a visual demonstration, I have in front of me this demonstration that we're going to be doing. So this is an example of a life insurance policy. This is a whole life insurance policy. When you buy a whole life insurance policy, the insurance company guarantees a death benefit that they will pay to your beneficiaries when you die. Whole life policies that are designed for cash value, growth and efficiency, will also have a cash value in the policy. And what that is that's money from the insurance company's general fund. The general fund at an insurance company has money that they use to pay the utilities for the company, to pay salaries for the employees, to pay their agents, and this is also money they make available to their whole life insurance policy owners, and the policy owners can access this based on the amount of premiums that they've paid and how big the policy is. When the premium is paid, death benefit is guaranteed, and the insurance company adds some money from the general fund to the cash value portion of this policy, and the policy owner can access this via policy loan. Over time, as more premiums are paid, this policy continues to grow. As far as the cash value is concerned, more of the general fund money is being made available to the policy owner for use. Now, the policy owner can take a loan with this, or they can take a withdrawal. If they choose to take a withdrawal, they take the cash value and they give up the death benefit. If they choose to do a loan, here's what happens. They come, they want a loan. They could take a maximum loan or they could take a partial loan. So they take a loan. The insurance company holds this death benefit now as collateral for the loan, and the policy owner takes this loan money and they can use it for whatever they want. If they don't pay it back and they die, the insurance company is going to use some of this as their collateral. But assuming they do pay it back, the insurance company gives this death benefit back for their beneficiaries. Now, let's suppose this policy owner had a maximum loan on their policy, and they were using this money, and they passed away. Well, the insurance company has moved this over as collateral when this loan was taken. And so now that the insured has died, they will take this death benefit and they're going to pay back the general fund. So they pay that back and they make this death benefit go to the beneficiaries. And this comes back to the general fund. So did the beneficiaries not receive their full death benefit? Well, we have to remember that the policy owner had taken a maximum loan and was using this money when they passed away. They hadn't paid it back. And so they had accessed this portion of their death benefit early. So if we take a look, yes, they did receive their full death benefit. It's just that it was split out, some in cash value and some in death benefit. With universal life insurance, things are a little bit different. So with a universal life policy, when you buy a universal policy, you have a death benefit. Now, this death benefit is based on term insurance that renews each year or every 3 or 5 years. And so, although the premiums for term insurance are very cheap while you're young, this is the most expensive type of life insurance that you can own. When you purchase a universal life insurance policy, you get a death benefit, plus there's a cash element to the policy. And what that looks like is you have premiums, and these premiums, when you pay them, the insurance company takes premium money to buy the death benefit, and they take fees and penalties from this premium, and then a little bit goes into your cash value fund. So this is actually your money sitting here with the universal life policy. Then this money goes over and does some index mirroring, fees, penalties on those earnings, and that happens year after year. Premiums come in, fees are deducted, death benefit gets paid for, and value starts growing in this cash fund. Now, over the time of several years, this cash fund increases in value. And if you were to die at this point, then the insurance company would pay both of these things. Well, this obviously needs to be paid. This is your money and the death benefit that you've been paying for. But if you don't die and you continue paying for this policy and you live to, past age 65, and things could change a little bit in these policies. What happens is that the premium that you pay each year, after fees and penalties and death benefit is paid for out of that, because this death benefit is built on term insurance and that goes up increasingly year by year, and the older you get, the more expensive this insurance gets. And so the premium that you're paying may be mostly used, the bulk of it, to pay for this, and which leaves very little to come into here. So as you're paying your premium, only a very little bit is getting added to your cash fund each year. Eventually what happens is you continue paying this premium, but nothing is getting added here. And because of the cost of insurance still has to be met, the insurance company actually starts taking money from here to pay for your premium, to pay for your death benefit. And as that happens year after year, you're still paying for it, with premiums, and now you're also paying for it with your money in your cash fund. And over time, the cash fund is depleted, but you still have premiums. So you continue paying those premiums, but they're not enough to satisfy this death benefit. And so the insurance company starts taking death benefit off the top. And you pay premiums, and the insurance company says it wasn't enough. You only have this much death benefit. And you pay premiums, and again, the insurance company takes more because they cannot continue accepting this premium and still provide you the whole death benefit. It's too expensive at this point. So eventually, what comes to happen is these policies run out of death benefit, and they run out of money in the cash fund, and all you're left with is premiums that you're paying for nothing. This is the sad story of the universal life insurance. So yes, while the universal life insurance does pay a death benefit and money that was yours in the cash fund, if you die, what happens long term? If you would like a more detailed explanation of how this works and like to see the numbers of universal life insurance policies compared to whole life insurance policies, go watch the video on our YouTube channel, How Life Insurance Works, and we'll link that for you in the description box. If you would like to get a whole life insurance policy that will work well for you, please contact our office. We will be happy to help you.